You think you control your credit card, but what if the card is quietly controlling you? Every tap feels painless. Every reward makes spending feel smarter. And every pay later pushes the real cost into the future. Millions of Americans do this every day without realizing what's happening, because the real product isn't the card, it's your spending. Credit cards are not inherently bad. For millions of Americans, they provide convenience, fraud protection, purchase flexibility, emergency access to funds, and rewards. When used responsibly and paid in full, they can be useful financial tools. The problem is more subtle. A credit card changes the moment when you experience the cost of a purchase. With cash, the transaction and the financial consequence happen almost simultaneously. You hand over something tangible and receive something in return. With credit, those two events can become separated. You get the restaurant meal tonight. The financial consequence arrives later. You buy the headphones today. The bill comes weeks afterward. That separation creates psychological distance, and modern payment technology pushes that distance even further. A contactless tap can take seconds. Online shopping can take even less. The less effort required to pay, the less opportunity there is to pause and ask a simple question. Do I actually want this, or do I simply want it right now? Research into payment behavior has repeatedly explored how the payment method can influence consumption decisions. More recent research also shows that credit line increases can influence spending patterns, including greater allocation toward higher value purchases. The card isn't making the decision for you, but it can change the environment in which you make the decision. To understand why credit cards can influence spending, we have to go back to the basic idea behind consumer credit. Credit allows people to separate purchasing power from immediate cash on hand. That idea transformed American commerce. Instead of saving until you had enough money for every major purchase, you could obtain something now and repay later. Over decades, revolving credit became deeply integrated into everyday life, but the business model created an important distinction between two kinds of customers. One customer uses the card for convenience and pays the entire statement balance every month. Another carries a balance and pays interest over time. For the issuer, these customers can generate very different economics. Interest isn't the only source of revenue in the credit card ecosystem. There can also be fees paid by merchants, annual fees, and other account-related revenue. Meanwhile, rewards can encourage consumers to place more purchases onto the card. This creates a complicated ecosystem involving consumers, banks, merchants, payment networks, and rewards programs, and the scale is enormous. The New York Fed reported that U.S. credit card balances stood at approximately $125 trillion in Q1 2026, while aggregate credit card limits increased by another $60 billion during the quarter. That last detail matters because a credit limit isn't just a ceiling. Psychologically, it can also feel like permission. The real problem begins when convenience becomes invisible. Imagine spending $8 on coffee, $70 on lunch, $42 on groceries, and $65 on something you didn't plan to buy. None of those purchases feels catastrophic, but the brain doesn't always naturally combine dozens of small decisions into one large financial consequence. A credit card can make each transaction feel like an isolated event. Then there is the language. of the statement. Instead of confronting the full balance, your eyes may immediately notice the much smaller minimum payment. The minimum is important because paying at least that amount keeps the account from becoming delinquent. But it isn't designed to eliminate the balance quickly. The CFPB explicitly advises consumers to pay more than the minimum when possible, because doing so reduces interest costs and speeds repayment. Research has also examined the psychological effect of minimum payment information. One study found that minimum payment figures can act as an anchor, influencing consumers towards smaller payments. And then there is interest. Many issuers calculate interest based on daily balances, meaning the cost can accumulate day after day when a balance is carried, so the purchase may take seconds. The financial consequence can last months or years. Paying. That transformation accelerated as payment technology became faster and more invisible. First came cards that replaced cash. Then online checkout removed the physical act of handing anything over. Then contactless payments reduced the transaction to a tap. And now smartphones can store payment credentials, remember information, and make purchases feel almost effortless. Every technological improvement solved a real problem: speed, convenience, security, accessibility. But every reduction in friction also changed the psychology of the purchase. A person standing in a store with a wallet full of cash has a natural stopping point. A digital payment can remove that pause. Rewards add another layer. A purchase doesn't simply cost money anymore. It can generate points, miles, or cashback. That creates a psychological reframing. Instead of thinking, "I'm spending $500, a consumer may begin thinking, "I'm earning rewards." The underlying purchase hasn't become cheaper merely because it generated points. And research on rewards cards has found evidence that rewards can stimulate spending, with some consumers ending up carrying higher unpaid balances. This is the turning point. The card isn't merely a payment instrument anymore. It becomes part of the motivation to purchase. So how does the system actually make money? The answer is more complicated than simply saying, banks want you to pay interest. Credit card economics involves several streams of revenue. When consumers carry balances, issuers can collect interest. When transactions occur, merchants generally pay fees associated with accepting card payments. With the economics distributed across the payment ecosystem, some cards also generate annual fees, and rewards programs can influence where consumers choose to spend. The important point is that the system doesn't require every customer to become deeply indebted. A profitable ecosystem can contain many different types of users. Some pay balances in full, some occasionally carry balances, some consistently revolve debt, and some pay fees while pursuing rewards or premium benefits. The incentives can therefore be surprisingly sophisticated. A bank doesn't randomly choose a number. Credit limits are connected to underwriting, risk, account behavior, and expected profitability. When a consumer receives a higher limit, the available purchasing capacity increases. Research examining credit line changes has found that increased credit access can cause spending to rise, including relatively greater spending on luxury categories. That doesn't mean every person spends more. It means the environment has changed, and once the environment changes, human behavior can change with it. The most powerful mechanism may not be forcing people to spend. It may simply be making spending easier. The next generation of credit isn't going to look like a plastic card. It's already becoming invisible. Payments are moving into smartphones, watches, online accounts, subscriptions, and increasingly automated purchasing systems. That creates a new question. What happens when spending no longer feels like an event? When a card must be pulled from a wallet, there is at least a physical action. When payment information is stored permanently, and purchases can happen with a few taps or automatically, the psychological distance between desire and transaction can shrink even further. At the same time, financial institutions have access to increasingly detailed information about consumer spending patterns. Researchers have even demonstrated the enormous analytical potential of credit card transaction data. A 2026 Federal Reserve-related research paper described a data set involving spending information from more than 350 million credit cards, showing how card data can be used to study consumption across U.S. counties. The future, therefore, isn't simply about faster payments. It's about smarter prediction. Systems can learn what people buy, when they buy it, and how their behavior changes. That can create better financial tools, but it can also create more powerful incentives to spend. The technology will become easier. The real challenge will be keeping human judgment in the loop, because the easier it becomes to say yes, the more valuable the ability to say no becomes. A credit card is only a piece of plastic or a digital number on a screen. It doesn't have a personality. It doesn't force you to spend, and it doesn't automatically make debt inevitable. But it can change the psychology of the moment when you decide to buy. It can move the pain of payment into the future. It can make rewards feel like savings. It can make a large credit limit feel like available income. And it can turn dozens of tiny decisions into one very large statement. That's why the most important question isn't, how much credit do I have? It's, how much of what I'm buying would I still want if I had to pay for it today? Because the real power of a credit card isn't the ability to buy something. It's the ability to make tomorrow's money feel like today's money. And once you understand that, the card begins to look different. Not as free money, not as extra income, but as a tool that can work for you. If you control it, or quietly work against you. If you don't, the next time you stand at a checkout and hear that familiar beep, remember, the transaction may end in 2 seconds, but the decision can follow you for months. And sometimes, the most valuable thing you can earn from a credit card isn't cash back, it's control.